This audiobook is written and produced by WealthBooks. Every tick of the market sends a jolt through our veins, a blend of exhilaration and terror, promising both lasting riches and crushing ruin. You've felt it, the knot in your stomach as prices plunge, the lure of a breakout stock whispered about in tones. This primal tug-of-war between fear and greed, honed in our past, still dictates billions in investments today. But what if you could master these instincts instead of being mastered by them? In the psychology of investing, we'll unravel the hidden forces steering your financial fate and equip you to chart a confident, rational path to wealth. Chapter 1. The Impact of Fear and Greed on Investment Decisions. From the moment our ancestors spotted a hungry predator on the savannah, fear and greed shaped every choice. Those instincts, fight or flight, hunt or hoard, lurk inside every investor today, whispering in their ear the same primal messages: sell now before it's wise, or buy it all and get rich fast. In this chapter, listeners meet three people whose decisions illustrate how instinct can hijack logic and learn simple, no-nonsense rules to take back control. Take Sarah, for example. In October 2008, she watched her retirement account drop 20% in a week. Heart racing, she sold every holding at a 10% loss. 2 weeks later, markets rebounded by 25%, and she had missed the gains. That gut punch taught her Rule 1. Never make a final decision in the first 48 hours of a big drop. Instead, she set an alarm to revisit her portfolio 2 days later, after the worst of the panic subsided. Then there's James, who heard about a flashy tech startup that doubled in price overnight. Greed overwhelmed him. He poured in without reading a single financial statement, betting his entire bonus on rumors. When the bubble burst, he lost half his money and spent months digging out of debt. His takeaway became Rule 2. If you can't explain in one sentence why a company could grow next year, you don't invest. Before buying, they write that sentence on a sticky note and refuse to trade until they understand it. These stories show how fear drives premature selling and greed fuels reckless buying. But they also prove that simple safeguards tame those impulses. Rule 3. Define your pain threshold before investing. That means deciding in advance how much you're willing to lose on any position, say 7%, so you'll hit pause before slashing a position in half. Listeners imagine setting a red flag alert at 7% down. When it rings, they step back, review their reasons, and resist the urge to bail out in panic. Our brains didn't evolve to handle flashing screens and one-click trades. They evolved to keep us alive, not to weigh quarterly earnings or dividend yields. When stock tickers scream in red, the same part of the brain that senses danger lights up. That's why Rule 4 is critical. Automate decisions where possible. Use limit orders to buy or sell at predetermined prices. Set up automatic contributions to investments every month, and program alerts rather than staring at every minute of market action. Automation buys the athlete's discipline that morning jog, stops emotional trading, and locks in your long-term plan. Consider Maria, who once watched Bitcoin tumble by 30% overnight and nearly sold, convinced she'd been duped. Instead, she'd set up a recurring purchase every 2 weeks. The automated buys meant she averaged into her position over months, smoothing out volatility. She never felt the pressure to time the bottom because she knew each purchase happened on autopilot. Over a year, her average cost became far lower than if she'd frantically chased dips or peaks. Beyond rules and automation, real success comes from spotting triggers. Listeners learn to journal every time they feel the urge to trade. They record the event, a Twitter panic, a friend's hot tip, a news headline. After 6 months, patterns emerge, say, big moves after Sunday night talk shows or a surge of anxiety when oil prices spike. Armed with that insight, they can pre-plan. If Johnson reads a breathless headline, he pauses, checks his journal, and remembers that 9 times out of 10, nothing fundamental has changed. Finally, greed isn't all bad. It's what drives innovation and rewards patience. But unchecked, it leads straight into punishing investments. Rule 5. Cap your speculation budget at no more than 5% of your total portfolio. That way, They can chase the occasional flashy opportunity without risking their foundation. If that tiny allocation tanks, it stings, but it won't derail retirement goals. Meanwhile, the remaining 95% stays parked in core positions built on strong cash flows and proven track records. By weaving in these real-life examples, Sarah's panic sale, James's reckless buy, Maria's autopilot strategy, listeners walk away with concrete steps, not vague stay calm platitudes. They learn that fear and greed are natural, but they don't have to be dictators. With clear thresholds, automation, bite-sized speculation, and a habit of self-examination, any investor can turn those ancient instincts into allies rather than adversaries. And with every disciplined choice, they reclaim control over their financial future, one rule at a time. Chapter 2. Understanding the Psychology of Investing. The investor rarely stops to wonder why they panic when the screen flashes red or chase a hot tip whispered in the break room. Yet every financial move is driven by instincts shaped over millennia. In plain terms, the brain plays tricks, turning a market dip into a survival threat and a speculative rumor into a golden promise. This chapter peels back those layers, revealing the mental shortcuts and emotional triggers that tip an otherwise rational plan into chaos, and, more importantly, shows exactly how to outsmart them. Take confirmation bias. When Emma stumbled on a bullish article about her favorite tech stock, she devoured every line and ignored the identical report warning of supply chain risks. Her portfolio swelled and then crashed. To stop this loop, she adopted rule number 1. For every positive research note she reads, she must spend as much time on a critical source. If she finds none, she treats the thesis as incomplete and holds off until she can. That simple swap, seeking a dissenting view as a first step, kept her from chasing one-sided hype and losing half her gains in a single week. Next comes anchoring bias, the tendency to fixate on initial information. In practice, Jake refused to sell a biotech holding until it hit his magic price of $120, even as industry news soured and competitors leapt ahead. His anchor became a trap, costing him months of returns. Now Jake uses rule number 2. Always reset the reference point. He does this by asking, if I saw this stock for the first time today, what would I pay? If the answer differs by more than 10% from his anchor, he revises the target. That habit forces him to adjust to new realities instead of clinging to yesterday's numbers. Herd behavior is next on the list. In 2019, when a social media frenzy drove meme stocks sky high, Carlos bought in at peak euphoria and faced a 40% drop as the crowd moved on. His lesson became rule number 3, wait for a quiet moment. Whenever headlines scream, don't miss out, he sets a 48-hour timer before any trade. That pause cools the impulse, letting him research fundamentals rather than ride the momentum of collective fear of missing out. 9 times out of 10, the froth dissipates, and with it, the risk. Loss aversion, feeling the pain of a loss more deeply than the joy of a gain, trips up dozens of investors every month. When Maya watched a small position slip from a $500 profit to a $200 loss, she held it, hoping to break even, only to watch it evaporate entirely. Now she enforces rule number 4. Set a stop-loss at 5%. If the position falls beyond that, the sale is automatic, no questions asked. To avoid emotional override, she programs her broker's app to execute instantly. By acknowledging that first-hand pain prompts bad judgment, she diffused its power with mechanical discipline. Overconfidence bias carries its own dangers. After 2 winning trades in a row, Leo swelled with certainty and doubled down on a complex derivatives play, then wiped out his entire quarter's profits. From that point, Leo built a simple checklist. Have I considered at least 3 reasons this could go wrong? Does this align with my core strategy? Are my position sizes within 2% of total capital? If any answer is no, he walks away. Rule number 5. No trade without a failure mode analysis. That extra step turned his reckless streak into measured conviction. Putting these rules together might sound like juggling too many tasks, but the key is routine. Before market open, create a bias kill sheet listing rule number 1 through rule number 5. Review any candidate stock against the sheet in under 5 minutes. Cross off each item as you satisfy it, and only then place the order. This transforms abstract psychology into tangible checkpoints, turning mental hurdles into practical steps. In a final case study, consider Olivia, a busy teacher who once felt paralyzed by conflicting advice. She built her buyer's kill sheet, tested it with a paper portfolio for 1 month, then committed 9% of her savings into the real market using only rules she'd already proven. By the end of that quarter, she'd outperformed her previous self by 12% with far less stress. More importantly, her decisions stopped feeling like gambles and started feeling like choices. That shift, from reacting to commanding one's mind, is the heart of mastering investment psychology. In understanding and countering the hidden forces in our own heads, any investor, novice or veteran, can turn instinct from enemy to ally. Chapter 2 shows that the greatest alpha isn't lurking in screen data. It's found by cracking open our own thought processes and rewriting them with exact, unbreakable rules. Chapter 3. Overcoming Emotional Biases. Imagine Sarah staring at her screen as her favorite tech stock slides 12% in a day. Her heart races. Cut my losses, she thinks, only to regret selling hours later when the price rebounds. This scene plays out in living rooms, coffee shops, and home offices everywhere. In Chapter 3, we'll break down how everyday investors like Sarah can recognize emotional traps and swap gut-wrenching mistakes for clear, rule-based actions. First, know your blind spots. 2 of the most dangerous traps are loss aversion and anchoring. Loss aversion makes people feel a $100 drop more painfully than a $100 gain feels good. Anchoring is when you fixate on an arbitrary reference price, say, the 52-week high, and freak out if the stock dips below it. Here's a fast, no-nonsense fix. Rule number 1. Turn data into alarms, not panic triggers. Set automated alerts at predefined levels, 5% down, 5% up. When the alert sounds, resist the urge to click sell or buy immediately. Instead, pause your screen for 10 minutes, breathe, and revisit your original thesis. Why did you buy this in the first place? Second, build a failure resume. That's exactly what it sounds like, a list of past investment mistakes, complete with the emotional triggers and financial results. John realized he'd panic sold 3 times in 2023, each time missing out on 8 to 15% gains. By writing it down, he could see his pattern. Every market rumor sent him running. Today, before making a move, John glances at his failure resume. Rule number 2, use your mistakes as road signs. When you feel the pulse-quickening urge to trade, skim your resume to see if that emotion matches a prior mistake. If it does, you've got a red flag to hold your ground. Next, implement a pre-commitment strategy. Top athletes and performers lock in routines so they don't waver under pressure. Investors can do the same. Choose 3 concrete actions you'll take when certain conditions are met. For example, rule number 3, pre-commit to periodic reviews, not continuous fiddling. Decide that on the first business day of each quarter, you'll review all holdings against your goals. No trading outside that window unless a pre-agreed rule fires, like a company bankruptcy announcement. This removes the temptation to tinker every time the market blips and turns investing into a methodical exercise. But what about herd mentality? When everyone around you is buzzing about Crypto X, it's hard not to dive in. Real-life case. Carlos bought in after a friend texted him it's going to moon. He lost 20% in 2 weeks and never saw a profit. To avoid this, use rule number 4, create an evidence dossier. When you hear a hot tip, write down 3 independent data points that justify the investment: revenue growth, analyst outlook, regulatory environment. If you can't find solid evidence in 10 minutes, cross that idea off your list. Over time, this habit trains you to follow facts instead of feelings. Even with checklists, emotional noise seeps in. That's why rule number 5, anchor to long-term goals, not short-term swings, is critical. Keep a visible chart of your target timeline, 5 or 10 years out, next to your desk or phone wallpaper. When a flash crash or sudden rally occurs, glance at that long horizon and ask yourself, does today's 7% drop really matter if I'm investing for a house down payment in 2030? This simple prompt cuts through the buzz and brings you back to what truly counts. Finally, enlist an accountability partner. Not every investor has a financial advisor on call, but almost anyone has a friend, spouse, or peer they respect. Agree to brief check-ins, 10 minutes once a month, where you report on your portfolio moves and emotional pressures you faced. Just like Sarah discovered, confessing her urge to sell her tech stock to her partner gave her that extra moment of reflection she needed to hold on. Rule number 6. Turn solo sessions into duet check-ins. When you know you'll have to justify your actions, you're far less likely to act on a whim. By turning these 6 rules into habits, investors swap emotional reactivity for disciplined action. They learn that a flashing red alert doesn't demand an immediate click, that past mistakes can be a guide, that pre-commitment builds muscle memory, that evidence trumps hype, that long-term goals outshine daily noise, and that accountability partners keep them honest. No more panic sells, no more FOMO buys, just calm, confident decisions rooted in strategy, not sentiment. In the next chapter, we'll explore how to build on this emotional foundation with concrete portfolio construction techniques. Until then, remember, mastering your mind is half the battle in mastering your money. Chapter 4. Building a strong financial foundation. Every strong investment journey begins with a secure base. In this chapter, the narrator guides listeners through 4 specific, no-nonsense rules to lay that groundwork, rules tested by real people and proven to work. First, set a concrete goal with an exact number and deadline. It isn't enough to say save for retirement. Instead, picture Jane, a graphic designer, who decided she needed $20,000 for her wedding in 18 months. She broke that down, $1,110 per month, or $260 per week. When she saw $260 on her online banking app each Friday, she knew exactly what to move into savings. That clarity replaces vague hopes with precise steps. Second, create an emergency buffer of 3 to 6 months of essential expenses in a high-yield savings account. Real pain hits when the car breaks down or an unexpected medical bill arrives. And that's exactly what happened to Carlos, a school teacher. He kept only a month's worth of spending in his checking account. When his car radiator failed, he drained his checking, sold some long-term positions at a loss, and missed out when the market rebounded days later. After that blow, he opened a separate online savings account paying 4.5% APY and automated a $200 weekly transfer. Now, if anything goes wrong, he has a cushion, and he never touches his investments for emergencies. Third, diversify across just a handful of broad asset buckets, using low-cost index funds or ETFs. Avoid chasing every hot sector or niche story. Picture Priya, an IT consultant who once spread her money across a dozen individual stocks, cryptocurrencies, and peer-to-peer loans. Each time she checked her phone, a new chart flashed red. She switched to 5 simple funds: a total U.S. stock market fund, an international stock fund, a U.S. bond fund, a real estate REIT fund, and a small allocation to a commodity ETF. She labeled each in her brokerage as growth, global, safety, income, and inflation hedge. That small portfolio gave her exposure without drowning her in data. When one bucket dipped, another rose, smoothing out the ride. Fourth, automate contributions and rebalance on a schedule, no emotions involved. Think of automation as the autopilot for your plan. After her wedding, Jane set up automatic transfers, $500 on the first of each month into her IRA, $200 into her brokerage account every payday, and $100 into her emergency fund weekly. No mental friction, no missed deposits. Equally important, she rebalanced every 6 months, or anytime an asset strayed more than 5% from its target. When U.S. stocks surged in January, her allocation jumped from 40% to 47%. Without thinking, she sold a slice of the U.S. stock fund and topped up her bond and international funds back to the 40 or 20 or 20 split she chose. That disciplined swap kept her from overbetting on anything. These 4 rules address the biggest stumbling blocks new investors face: unclear goals, no safety net, overconcentration, and emotional trading. Here are 3 additional pointers to sharpen the edge. Use a 2-bucket approach for short-term needs. If you know you'll need cash within 2 years, say, for a down payment, keep that money in an ultra-safe bucket like a short-term bond fund or a high-yield savings. Label it near-term. Everything else is long-term. This simple split stops short-timers from liquidating long-term positions when panic strikes. Limit the number of funds. Too many choices lead to paralysis. Aim for a maximum of 5 funds. If you find yourself tempted by a sector fund, say, robotics or biotech, ask, is it mission-critical or just noise? If neither you nor your spreadsheet can justify it clearly, skip it. Track progress visually. Nothing motivates like visible progress. Mark your calendar with a monthly checkpoint. Plot your account balances in a simple line graph, just 2 points per month. When you see the slope steadily rising, even through small drawdowns, you gain confidence to stick with the plan. By following these steps, anyone can transform fragmented savings and frenetic trading into a coherent, resilient strategy. Jane hit her $20,000 wedding goal 8 weeks early. Carlos never worries about surprise bills again, and Priya sleeps soundly knowing she's diversified without obsession. Their stories prove that a strong financial foundation isn't about rare insights or lucky picks. It's about clear targets, automatic habits, sensible buckets, and regular tune UPS. With these rules in place, the path to wealth isn't a mystery. It's a steady walk built one automated step at a time. Chapter 5: Empowering Yourself for Financial Success. Sheila wasn't born with a silver spoon. She worked 3 part-time jobs to pay tuition and still managed to sock away $50 a month into an index fund. When she landed her first full-time position, she didn't chase flashy hot tips. Instead, she treated investing like brushing her teeth, non-negotiable and done without glamour. That simple habit turned her small contributions into a 6-figure nest egg over a decade. Sheila's story isn't magic. It's the product of clear rules, relentless consistency, and emotional intelligence. First, set a weekly learning sprint. Every Tuesday at 7 p.m., block 30 minutes on your calendar labeled Market IQ. Use that time to read one well-defined article, say, a concise breakdown of the latest GDP report, or watch a 5-minute explainer on bond yields. Don't binge entire books. Focus on bite-sized, high-signal pieces. Actionable rule: use an RSS reader or a single trusted newsletter, e.g., Morning Brew, and limit yourself to 5 sources. Overloading leads to confusion. Clarity comes from consistency. Next, build your decision checklist. Before buying or selling any asset, run through 4 bullet points in under 2 minutes. What's my target price? What news triggered this thought? How does this fit my goals? Am I acting today or projecting 6 months ahead? By treating trades like minute presentations to yourself, you inject rational distance. Case in point, James, a teacher, drafted his checklist on a post-it note stuck to his monitor. When the crypto frenzy hit, he paused at the checklist and opted out, saving him from handing over thousands in panic. Sheila also automated her savings and investments. She knew that discipline falters when willpower dips, like at 3 a.m., scrolling headlines in a bleary-eyed panic. So she set up 2 automatic transfers, 5% of her paycheck into a low-fee target date fund, and 3% into a high-yield savings account for emergencies. Actionable rule: use your employer's direct deposit split or your bank's scheduled transfers. Don't think, don't tweak, let your system run. Real-time tracking doesn't require you to stare at candlestick charts. Instead, create a monthly pulse ritual. On the first Saturday morning of each month, open your brokerage app for exactly 10 minutes. Note total portfolio value, compare it to last month, and log the percentage change in a spreadsheet. If you see a swing over 8%, pause and check macro headlines. Otherwise, move on. This ritual trains you to acknowledge volatility without overreacting. Over 2 years, This habit sharpened Sheila's sense of normal market wiggles versus real red alert scenarios. Peer accountability multiplies success. Sheila joined a small online circle of 3 colleagues who met once a quarter via video call. Each person shared one victory, e.g., I rebalanced to cut tech weight by 5%, and one question, is it time to add bonds? This candid forum kept her honest. She couldn't hide mistakes, and she gained fresh perspectives. Actionable rule: form or join a group of 2 to 4 people with similar horizons. No more. Beyond that, conversations fragment and lose focus. Mistakes will happen, and that's okay. When James accidentally sold the wrong 100 shares of his dividend ETF instead of 10, he faced an $800 difference. Instead of beating himself up, he logged the error in his learning journal under the heading Slip-Ups and Safeguards. For each mistake, he wrote a 1-sentence cause and 1 rule to prevent recurrence. After 3 months of journaling, his errors dropped by 70%. Actionable rule: keep a simple Google Doc titled Trade Diary. Update it within 24 hours of any misstep, and review quarterly. Finally, cultivate the long-view mindset by imagining your future self. View each contribution as a gift to retirement you. Sheila taped a photo of her 80-year-old idol to her office wall with the caption, "Thank yourself later." Whenever temptation arose, to chase a fad spinner, to cash out for a shiny gadget, she looked up and remembered who she was building for. Actionable rule: place one visual cue in your workspace that reminds you of your long-term mission, be it a photo, a quote, or a symbolic object. By weaving these specific habits, learning sprints, decision checklists, automated transfers, monthly pulses, peer accountability, mistake journaling, and future self cues into her daily life, Sheila transformed chaotic market noise into a calm rhythm of progress. These steps don't require insider access or advanced degrees. They demand only clarity, consistency, and a willingness to outsmart our own emotions. Follow her blueprint, and you will find yourself not just surviving market storms, but steering confidently toward your financial horizon. Chapter 6: The Power of Patience and Compounding. Maria first felt the sting of impatience when she checked her retirement account every morning and watched it jiggle up and down with every tweet about the economy. She wondered why a steady deposit of $50 a week didn't feel like magic happening overnight. In reality, magic takes time. Patience isn't just a polite suggestion. It's the engine that turns small, consistent investments into life-changing sums. Take the case of David, who parked $200 a month into a low-cost index fund for 20 years. He never tried to time the market or chase headlines. He set an automated transfer on payday and never touched it. At age 60, his account balance had grown more than 30-fold. That wasn't luck. Those returns were powered by compounding, the process where returns themselves start generating returns, year after year. Here's an easy rule of thumb: automate contributions and let them ride. If an investor logs into their account fewer than once a quarter, they save themselves the anxiety that prompts bad decisions. Maria stopped logging in every weekend once she switched to automatic contributions. She discovered that out of sight truly became out of mind, in a good way. Without the impulse to sell when the market dipped, her portfolio kept growing. Another tactic: reinvest all dividends. Mark once received a quarterly dividend check and treated it like found money. He used it to buy gadgets. After a friend explained how reinvesting that payout could buy more shares that, in turn, earn more dividends, Mark changed course. Over 10 years, those reinvested dividends accounted for nearly half of his gains. That simple choice, reinvest or spend, made a huge difference. To turn compounding into a habit, follow 3 straightforward rules. Start early, even if it's small. Maria began with just $50 a month. That tiny contribution cemented the routine. As her income rose, she boosted the amount. Automate everything. Set up recurring transfers so money leaves the paycheck before temptation strikes. Never interrupt the process. Resist the urge to pause contributions during downturns. They are opportunities to buy low. When the market plunged by 20% in a month, Maria read headlines urging panic selling. She ignored them, knowing downturns accelerate compounding. Each share bought at a discount magnifies future returns. She mentally noted, market dips are discounts, and one morning simply increased her transfer by 10%. That extra boost during a crash did more for her balance than several weeks of normal investing. To simplify compounding's power, use the rule of 72. Divide 72 by an expected annual return, say 6%, and you get 12 years to double your money. If Maria expects a 6% return, her $50 monthly plan becomes $100 every dozen years, or without lifting a finger beyond setting it up. This isn't a forecast. It's a quick way to see how patience amplifies results. Specific pain points deserve direct solutions. If checking your balance every day triggers panic, delete the app. If boring spreadsheets feel like homework, download an app with a simple gauge. Green zone for on track, red zone for attention. David used a sunrise-themed dashboard that only showed his balance once a month, reminding him that compounding isn't about daily thrills. Avoid common expert traps, like constantly shifting funds chasing last quarter's star performer. Maria once hopped between growth and value funds every 6 months, paying fees and losing sleep. She switched to a blended portfolio of broad funds, slashed her fees by 75%, and regained her evenings. The fewer decisions she made, the greater her results. At its core, compounding demands emotional discipline. When headlines scream crash or boom, the compounding investor stays calm. Maria practiced a simple morning routine. Pour coffee, read one financial fact, then ignore the rest until sunset. That ritual kept her on script, resisting the urge to tinker with her investments. In the end, patience and compounding become a partnership. They reward the investor who resists impulses, who automates, reinvests dividends, and quietly lets time work its miracle. Maria and David both proved that starting modestly, sticking to a plan, and avoiding noise transforms a trickle of money into a river of wealth. For anyone frustrated by slow beginnings, their stories offer clear proof. With patience, compounding doesn't just add up, it multiplies. Chapter 7. Aligning Money with Values and Purpose. Sarah leaned back in her chair and thought about the last time she cringed watching a news segment on climate change. Her heart raced, not just from fear for the planet, but from the knowledge that her own investments were propping up some of the worst offenders. Like many investors, she wanted her money to matter. Yet she felt trapped between vague promises of green funds and the overwhelming jargon of ESG ratings. This chapter lays out a simple, step-by-step roadmap for anyone who wants to turn financial portfolios into purposeful tools for change, without sacrificing returns or getting lost in buzzwords. First, the investor must get crystal clear on personal values. It sounds obvious, but most people skip this step. Sit down with a blank sheet of paper and write out 3 things that matter most: clean air, gender equality, community development, whatever lights a fire in your belly. These aren't categories for a financial advisor. They're the lens through which every investment decision will pass. As Priya discovered, listing her top values helped her spot funds that just claimed to be sustainable versus those with verifiable track records in renewable energy and affordable housing. Next, turn values into measurable criteria. Saying, "I care about human rights" is noble, but it isn't actionable. Define what that means. I will invest no more than 5% of my equities in companies with labor violations flagged by the International Labor Organization. For example, Priya set her own threshold by using free online tools like the UN's Global Compact database and the ESG ratings from multiple providers. Having hard lines prevents the greenwashing trap, where funds plaster a leafy logo on their website without walking the talk. With criteria in hand, it's time to research specific vehicles. Forget hunting down obscure impact funds with tiny track records. Start with 3 familiar, low-cost index or ETF options that meet your criteria. Sarah found a clean energy ETF, a community bond fund that finances local affordable housing, and a women-led business fund. Each met at least 2 of her top values and cost less than 0.3% in fees. By limiting herself to 3 core holdings, she avoided analysis paralysis and simplified tracking. Monitoring real-world outcomes is the next secret no one talks about. Quarterly statements with dollar figures are sterile. What matters is stories. Every 3 months, Sarah reads the fund manager's impact report and picks one example to follow up on: a solar farm installation in Texas or microloan portfolio in Kenya. She then searches for news articles or non-profit reviews to see on-the-ground results. This habit took just 20 minutes and made her feel connected, not just number crunching. Rebalance with purpose, not just percentages. When traditional portfolios hit their target weights, automated rebalancing keeps emotions in check. But for purpose-driven investing, rebalance based on impact momentum. If one of your criteria, say, affordable housing bonds, sees new policy support or lower yield risk, you might choose to modestly overweight that position by 2 to 3% of your overall portfolio. Priya did this after her community bond fund announced expanded partnerships with city governments. Her extra allocation generated both higher yields and a stronger sense of engagement. Donor-advised funds, DAFs, deserve an honorable mention. They let you earmark money for charities while offering immediate tax benefits. For the values-minded investor with a giving streak, funneling a small percentage, 2 to 5% of annual contributions, through a DAF aligns both philanthropic and financial goals. Sarah earmarked funds for a nonprofit rebuilding mangrove forests. Each year, she reviews its progress and decides whether to renew support or pivot to a different cause. That choice keeps her portfolio aligned with evolving passions. Avoid set-and-forget syndrome. Many advisors tout the beauty of a hands-off approach, but purpose-driven portfolios need attention. Set calendar reminders for a 30-minute check-in each quarter, review values alignment, read one impact report, and adjust allocations by no more than 5% if warranted. Stick to this rule religiously. Without discipline, it's all too easy to default back to generic index funds or chase the hottest tech IPO, exactly the trap you're here to escape. Finally, measure success in more than dollars. At the end of each year, reflect on 3 questions. Which investments drove the greatest real-world impact? Which decisions felt most aligned with my values? Where did I compromise, and why? Write these answers in a journal or digital note. This qualitative checkpoint is as vital as your brokerage statement. It keeps your purpose fresh and your financial plan honest. Sarah's transformation didn't happen overnight. It took 3 months of consistent effort, defining values, setting criteria, choosing 3 core investments, and maintaining quarterly check-ins. Yet today, every time she logs into her account, she feels a surge of pride. Her money no longer floats aimlessly in the market. It stands for something. And that simple shift, from passive holder to intentional investor, creates a quieter mind, a fuller heart, and, ultimately, a richer life in every sense that matters. Chapter 8. Navigating the Future of Finance, Innovation and Change. In the next 5 minutes, listeners will find out how to turn high-tech buzzwords into simple, money-making moves without getting overwhelmed. Technology has stormed into investing, artificial intelligence, robo-advisors, tokenized real estate, decentralized finance, but most people still treat it like rocket science. That stops today. First, let's get real about pain points. Jane, a 42-year-old graphic designer, poured $5,000 into a popular crypto platform last year because she heard everyone's making money. She never read the fine print on fees, didn't set withdrawal limits, and got wiped out when that platform froze withdrawals for 3 weeks. Meanwhile, her friend Mike put $2,000 into a robo-advisor with a 0.25% annual fee, a built-in rebalancer, and an AI-driven tax loss harvester, and beat Jane's manual picks by 4% in under a year. Big gap, right? Here's how to shortcut the learning curve and build a strategy that survives and thrives in tomorrow's markets. 1. Treat AI like a power tool, not magic. Rule: always know what questions you're asking. If an AI-powered advisor suggests you invest in global tech growth, dig deeper. Is it weighting 5 megacaps or 200 small innovators? Call customer service and ask for the ETF or fund holdings. If they can't or won't tell you, walk away. AI can crunch billions of data points in seconds, but garbage in, garbage out. Only use tools that let you peek under the hood. 2. Start small with new platforms. Case study. Carlos, a nose practitioner, wanted to try tokenized real estate, a fancy way to own a slice of an apartment building through blockchain. He allocated just 1% of his total portfolio, $500, and tracked distributions monthly. When a developer delayed rental income disbursement by 2 months, he wasn't staring at a $50,000 loss, just a $5 hiccup, and he learned how to read smart contract terms. Rule: cap new tech bets at 1 to 2% until you've lived through delays, fees, and real-world glitches. 3. Automate your guardrails. Pain point: emotional trading spikes when your phone buzzes with urgent RA driven by signals. Solution: set limit orders and stop-loss triggers before you click invest. Modern robo-advisors let you automate rebalancing, tax loss harvesting, even monthly top UPS. Use them. Jason, a school teacher, turned on auto-rebalancing at 5% drift and forgot about his portfolio for a year. He returned to find his allocation exactly where he wanted. No late-night panic selling. 4. Vet fees and data privacy policies like a detective. A 0.5% annual fee might sound small until it's $500 a year on a $100,000 portfolio. Rule: aim for total fees, management plus transaction, under 0.3%. And don't skip the privacy section. Some free robo-advisors monetize your data. If they are scanning your bank account or credit card statements, read how they store and share that info. Your nest egg isn't worth trading your financial history. 5. Embrace decentralized finance. But don't get decentralized with your emotions. DeFi promises no middleman and juicy yields. Yet high-interest crypto savings accounts vanished overnight in past winter cycles. Rule: keep at least 90% of long-term savings in regulated vehicles, IRAs, 401(k)s, brokerage accounts, and treat DeFi like a high-volatility experiment. Allocate no more than 3 to 5% here. When yields exceed 8%, ask why. If there's a catch, smart contract risk or liquidity lockup, make sure you're ready to live without that money for months. 6. Build adaptability into your strategy. Check your plan quarterly, not daily. Technology shifts fast: AI models, blockchain protocols, token standards. But your life goals don't. Sarah, an IT consultant, reviews her portfolio on the first business day of each quarter. She compares performance, reads one industry report, then decides if she needs to shift allocations. That small, consistent routine keeps her ahead of change without spinning her wheels every time Bitcoin drops 10%. 7. Lean on human expertise for complex decisions. Even the slickest robo-advisor can't coach you through a mid-career pivot or tax loss harvesting in an oversold sector. Rule: hire, or at least talk to, a credentialed financial planner once a year. Use the conversation to challenge your assumptions. If AI says buy, your advisor might say hold, because your tax bracket changed. The blend of machine speed and human context is unbeatable. By turning high-flying fintech into a few straightforward rules, peek under the hood, start small, automate guardrails, vet fees, cap experimental bets, review quarterly, and lean on experts, you can surf the wave of innovation instead of wiping out. The future of finance isn't a black box, it's a toolkit. Use these tips, stay curious, and you'll be in a position not just to keep up, but to pull ahead. The end. We hope you've enjoyed the audiobook. This audiobook is a production of WealthBooks. Copyright 2025.